Shaurya, can you see this?
Yes, ma'am.
Let me see where I've given your marks, because you know all of this is the PDF the correct one, or the Word
Yes, ma'am.
document is the
Ma'am,
correct?
actually, I had submitted a PDF and a Word document. So this is
So it's
just
the
one.
same thing, na?
Yeah.
Okay. Okay. And how much have you got total?
Ma'am, I got 2 out of 20, which was way less than what I had anticipated. So that's
Yeah.
why I just was a little shocked at the first. So
Okay. Okay. So just a second. Shaurya Srivastava, 4131. Okay. So first, Shaurya, जो तुमने आंसर लिखा है ना, hiring cost can be decreased, it can be reflected in the increased performance bonus on the liability. ऐसा कुछ भी नहीं होगा, ठीक है? जो परफॉर्मेंस है आपके वर्कर्स की, दैट इज अ क्वालिटेटिव थिंग एंड इट हैज नो क्वांटिटेटिव बेसिस थ्रू द मनी मेजरमेंट कॉन्सेप्ट. इट कैन नॉट बी शोन एनीवेयर.
ma'am,
ठीक है?
actually, what I was hinting at was giving them a performance bonus, like to sort of kind of
I have
make a
not asked you
quantitative.
about whether you should give them a performance bonus or not. I just said whether this will be recorded or not. Okay? परफॉर्मेंस बोनस देना या ना देना वो ह्यूमन रिसोर्स डिपार्टमेंट का काम है, वो फाइनेंस वालों का इससे कोई लेना देना नहीं है. ओके?
Right.
Then in the second point, dividend payout will increase net cash burn and reduced accounts receivables leads to increased cash burn. No, the first thing is fine. Dividend payout will increase net cash burn, तो उसमें आपको आधा मार्क्स मिल सकता है. I think तुम्हारा ये first वाला question PDF में नहीं था क्या? Let me check your PDF.
Ma'am, PDF में सिर्फ only the numericals were there, so like the
Oh, why did you do this, Shaurya?
ma'am, because like it was far easier to solve the numericals on paper than type them out, because it would have
But
taken.
couldn't you have submitted one thing? Now you're submitting numericals alag se and you're submitting that
Ma'am,
alag se.
actually,
What?
ma'am, in the last course MSL 307, I had actually done the same thing and it was valid there, so I just assumed that it would
नहीं,
be
it was
valid.
not valid. It was just that मैम जो है extra confusion जो है उसको bear कर ली थी, and this time you know I have not been able to see the other one because I thought कि you've submitted both the PDF and the Word version.
No, ma'am,
I
actually, I
didn't know
was.
that you solved half the thing in one version and half the thing. Please don't do this, okay? It leads to
Yeah,
a lot of unnecessary confusion.
sure, ma'am. I wasn't aware
So
that we
this
were.
is okay. So this is the numerical section that you have
Yes.
done.
Yeah.
Now in that you have this equity in the beginning correct. This is the correct value, but then the end equity value is wrong, and also the highest sustainable growth rate is wrong. Also the financing policy factor is also wrong. Then the additional funds required is also wrong. So basically you've got 1 mark over here. In the third question, the first part, that is COGS value, is right. So you've got 1 marks here, and then after that survival revenue is wrong. So you've got 1 mark here. Okay, so these are 2 marks. And then of course you've sent the Word document, which I thought that you know you have already done. So in this you get half a mark in B2. C, I can give you 1 mark. So this is 1.5. Subscribed capital is wrong. The net profits are reported as retained earnings. Okay, I can give you 1 mark here also. So Samriddhi, just keep a tab on this. So this is half, 1 and 2. So 2.5 here.
Okay, ma'am.
Okay, let me look at this. In the second question, is Spotify and Uber a partnership, Shaurya?
Yes, ma'am. I actually read about this somewhere that they had actually.
Can you please indicate where it is given that Spotify and Uber are partnerships?
Ma'am, actually, before, like, I was just going through an article a few days back, like, wherein it just mentioned that.
Can you please share that article where it says that Spotify and Uber are partnerships?
Yes, ma'am. I'll look for it.
Then the premium earned on each share can be utilized to compensate the underwriters who help with the process of deciding the price. No, it cannot. Premium is legally owned by the owners and not to the company, and they have to be allotted the shares to return the. No, completely wrong. So here, Samriddhi, we can give him 1.5 marks, even though the examples that he has shared are wrong. So
Okay,
कितना हो गया
ma'am.
total, Samriddhi?
Ma'am, like agar originally he had 2, so we will add 4 marks more to 6.
मतलब इसका 1.5 और ऊपर का 2.5.
Yes, ma'am.
ठीक है, तो ये ऐड कर दो इसका, बिकॉज इसका हमने ये वर्ड डॉक्यूमेंट अलग से नहीं देखा था. आई डिडंट नो दैट ही सॉल्व्ड हाफ द पेपर इन द वर्ड डॉक्यूमेंट एंड हाफ इन द पीडीएफ.
Okay,
Ma'am,
ma'am.
also like I just found out the article that I was reading about Uber and Spotify. So, how do I share the link? Can I
You
mail?
can just,
Can I WhatsApp it to Samriti ma'am so that she
yes,
can share?
yes, you can WhatsApp it. Okay.
Okay.
Now, what I was asking for over here is basically the kinds of organizations जो completely अपने owners के ऊपर survival के लिए depend करते हैं. So उसमें आपने दोनों नाम तो सही दिए, sole proprietorship and partnership, and you have written that liability is distributed among partners, which is not entirely correct. अब हमारे पास limited liability partnerships आ गई हैं. और जो सेकंड पार्ट था इसका, उसमें ये था कि अगर आपके पास ओवर सब्सक्रिप्शन ऑफ शेयर्स हो या शेयर्स आपके प्रीमियम पे सेल हो रहे हो, तो उनको आप क्या कर सकते हो, व्हाट कैन यू डू विद दैट. ओके, but you can definitely not use the premium money to either compensate the underwriters or make a pro rata allotment. Okay, premium cannot be used for all of these. Premium can only be used for specific purposes which I have told you in the class. Okay.
Okay.
तो शौर्य, अच्छा हुआ तुमने ये बता दिया, क्योंकि वरना हम वर्ड डॉक्यूमेंट तुम्हारा यही सोच के नहीं खोलते कि यू हैव सबमिटेड बोथ वर्ड एंड पीडीएफ.
Yes.
Please do not do this in the future. Please don't solve half the question paper in one format and half in another format. Please don't do that. Please submit one document, okay,
All right.
like
Yeah, I'll do
everyone
that.
else has.
Sure, sure. All right. Ma'am,
Okay.
just one more question. Yeah.
हाँ हाँ,
Just
बताओ.
regarding the last question in the minor, ma'am, since they had asked us to calculate the additional funds required in case we ma'am, I don't remember the exact language, but it just needed the additional funds that were required. But however, there was the expected growth rate of the sales was not really given. So so in that case, I just assumed that to be equal to the part that we had calculated earlier in the second part, in the second part wherein we
No,
calculate.
no, it was given very clearly. Estimate the additional funds required at the current sustainable growth rate. Okay,
Yes,
so
ma'am.
whatever was the current sustainable growth rate, looking at the data given, on that basis you had to estimate the additional funds required, not at the maximum most sustainable growth rate or anything.
Okay.
Okay, so Samriddhi will share the solutions with you guys so that it is evident to you कि कैसे करना था.
All right. Sure.
Okay.
And ma'am, lastly, I've just shared the link with Samriddhi ma'am. So just can you please have a look at the link that I shared and
ठीक है, प्लीज
just have
उसको समृद्धि हमको फॉरवर्ड कर देना.
Okay, ma'am. Okay.
ठीक है, और बताओ, anyone else?
Thank you so much, ma'am.
Thank you, sure. Anyone else who has any doubts regarding their answer scripts, question papers? I am announcing this in the class. I have told Samriddhi to send out an email to the entire class. There are 3 people who seem to have submitted the same PDF with just the names changed. So we are issuing a warning to these people, and I'll keep a watch out for these 3 people, and we'll see how they perform in the future and what kind of sheets they submit. Okay. Anyone else? Aniket, Kamya, Shaganti. It's nice to see Kamya, Shaganti, sure you're here because I generally don't see you in class. Anyone else? Okay. I believe you guys have asked for another extension on the group presentation. So now they're happening on Friday and I will not give any further extension. So please keep that in mind. Samriddhi, इनका CR कौन है? अनिकेत ही है?
नहीं मैम, अभिनव है.
अभिनव है? अभिनव नहीं है यहाँ पे ना?
Yes.
ठीक है. Acha, and guys, is there a timetable issue? Now do you have labs in this slot? इन लोग तो कुछ बोल ही नहीं रहे.
Ma'am, actually, the issue is with certain people who have a certain course called SBL 100. So the lab is only scheduled for those people. So not
No, but
everybody.
how can they schedule the lab when there is a class slotted for them?
Right, ma'am. As far as I understood, like they had actually wanted to finish the labs and they had a crammed timetable, so they had actually fit in more lab sessions. So
No, but
that's why
then
they.
what about the classes that have been scheduled by the central admin in these hours?
Yes, ma'am. It appears that there is a
This
clash.
slot has come from the central timetable. We have not made it. We are just following the central timetable. So just tell these guys, Samriddhi, you can send out an email also कि जो ये जो slot वाला problem हो रहा है, इसको they
Yes,
should take
ma'am.
it up officially and either get this slot changed or get the lab slot changed.
Okay, ma'am.
ठीक है?
Yes, ma'am.
Okay, anyone else about the question paper or about whatever Samriddhi ma'am discussed with you in the last class on valuation? Any doubts, any questions, please ask. Okay, fine. So if there are no doubts, then let me share my screen again and we can go back to the material. Is Samriddhi, is this visible?
Yes, ma'am, it is.
ठीक है. And you were here only, na? You left it here
Yes,
only?
ma'am. Yes, ma'am.
ठीक है. Okay, thanks so much, Samriddhi. So moving on, dear students, Samriddhi would have told you that there are whole lot of qualitative measures that we use when we are valuing startups which are especially in their seed or development stage, because they don't have any financial operating history, and even if they have projections, these projections are pretty uncertain and highly inaccurate. Okay, so you must have done the Berkus method, the scorecard method, the risk summation method, and so on. And these methods are also in line with that. I think before that you must have done the risk summation, right? Yes. So all of these methods, I hope you have understood. In case anyone has any doubts or questions, you can ask. Now, book value and liquidation value are very traditional methods which are used for seasoned companies as well. Okay, and they can be applied to a startup that does have some asset base. So, not a complete development stage startup, but maybe a startup that has been formed and has some assets of value. Okay. So in this, basically, book and liquidation values are similar methodologies that differ only in their assumed transaction circumstances. Book value refers simply to the net worth of a company as it stands today. Book value मतलब assets की क्या value है, क्या book में क्या value. That is a tangible asset value less any liabilities on the company's balance sheet. In contrast, liquidation value is an illustrative methodology that assumes a company is going out of business and all of its assets are liquidated. Now, whenever a company is in any trouble and it has to forego a forced liquidation, okay, or just it goes into bankruptcy and has to be liquidated, then naturally, because it is distress selling, the assets of the company do not fetch the same price as they would have had the circumstances been normal. People realize this. Okay, people realize that the company is desperate, it is wanting to sell off its asset to raise money, and hence the price that people are willing to pay for those assets is falls drastically. Okay, so both book value, liquidation value essentially mean the same thing. The only difference is the circumstances in which we are gauging the value of these assets. How does it work? You total up the value of all of a company's tangible assets on its balance sheet, and next total up all of the liabilities and subtract them from the tangible assets. So liabilities means all the external liabilities, not the owner's money, not the shares, the share capital, but the external liabilities. Now you're left with the net tangible asset value. If you're performing a liquidation analysis, go a step further and assign a discount to each tangible asset line item on the balance sheet. Discounts due to the liquidation circumstances will vary based on the industry, market conditions, and type of asset. Appraisers typically provide both orderly मतलब normal course of business में जब bankruptcy हो जाती है, and forced liquidation values, the latter being lower due to the forced nature of the sale. Forced liquidation typically तब होता है when law takes over, like what is happening with Vijay Mallya's assets or Nirav Modi's assets, where they are being forced into liquidation simply so that the creditors can be paid off. Okay, so when a legal action takes place, then it's called a forced liquidation. Okay, so look at the example here. We have the current assets of a company: cash, accounts receivable, inventory. We have fixed assets in terms of property and equipment, and we have a total asset value of $75 million. In terms of current liabilities, we have notes payable, accounts payable, and we have long-term liability of debt at 20 million. This gives total external liabilities at 45 million. So the net book value is nothing but total assets minus the total external liabilities, and that is the net book value is $40 million. Now suppose the company had to undergo liquidation, then in that case we will discount the value of the assets depending on the kind of liquidation, whether it's orderly or it's forced. So naturally cash की value हमेशा वही रहती है. So cash will always be discounted at 100%. Accounts receivables are discounted at 80% in case of an orderly discount, and they're valued at 50% in case of a forced discount. Inventory is valued still lower at 50% in case of a ordinary liquidation, and only 30% in case of a forced liquidation. Property and equipment is also valued only at 75% and 65% in case of liquidation. So when we value these assets at a discount, the net total assets becomes 54.90 in the case of an orderly liquidation, and 45.10 in case of a forced liquidation. Because the assets are being liquidated, they fetch a much lower value, and hence you can see that normally the company had a net value of 40 million, but now in case of an orderly liquidation, it's just 19.90 million slashed by half, and in case of a forced liquidation, it's just 10.10 million, that is slashed by around 75%. Okay, so the advantages of this method is that it provides the most directly quantifiable valuation of a company. This is the first time that we have actually quantified the value of a company through its balance sheet, through its tangible assets, less a company's balance sheet liabilities. Liquidation value provides investors with a clear sense of risk by providing a floor recovery कि भाई हमें minimum मतलब जो value मिलेगी वो 10.10 मिल जाएगी. The disadvantage is that it's a highly simplistic valuation methodology that does not factor in intangible asset value and future growth potential. So you're looking at the balance sheet today, but what about the future growth potential? Then you're looking at the tangible assets that can be valued directly, but what about intangible assets, patents, technology? Okay, this is not very relevant for startups either, because in the early stages where value lies primarily in future growth and also in intangible assets like intellectual property, a startup would not typically have these many tangible assets anyway. Okay, so that is why these methodologies are used more for seasoned companies. Okay, any doubts, any questions so far? Coming back to the session. Okay. Then we come to another very popular method, which is called the venture capital method. It was first introduced by Professor Bill Salmon at Harvard Business School. And Professor Salmon is considered one of the pioneer professors of entrepreneurship in the 1980s. So imagine more than 40 years ago, when India was not even talking about courses on entrepreneurship or anything, and has been slightly modified since. This method uses the potential exit value of a company and the target rate of return of an investor to back into a post-money valuation. Now, students, you will keep hearing about these terms: pre-money, post-money valuation. It basically means when you're applying for a funding round, what is your value then is called the pre-money valuation. And then your post-money valuation is the pre-money valuation plus the amount of funding that you have received. That gives you the post-money valuation. Okay. So how does this work? First, let's determine the terminal value, that is the exit value of the startup. In our example, we assume that the company will exit at a valuation of $10 million. The terminal value can be determined through a number of methods, like we have already done in the beginning, the DCF method. Typically, investors can project out revenue for 5 to 10 years and then imply a valuation in the last projection year using average sector PS multiples. Now, PS multiples are nothing but price to sales multiples. You must be familiar with the PE ratio, that is the price to earnings multiple, but that is very popular in stock markets. But the reason why we don't use PE ratios for startups is because they generally don't have earnings. And if they do, in the beginning, they're making losses. So a good indicator of their volume or their market is sales. So we use sector PS multiples, okay, instead of using PE multiples. Estimate the time it will take before an exit is reached, usually through an IPO or acquisition. In our example, we are assuming that it will take startup widget company 5 years to reach an exit. Using the post-money valuation formula, discount the terminal value back to the present value using the hurdle rate. Now, this hurdle rate is nothing but the discount rate or the rate of return that the investor is targeting. Okay. So when we discount this to today's value, it will give us the current post-money valuation. To find the pre-money valuation, simply deduct the investor's contemplated funding amount. तो उसमें से funding आप हटा दो post money में से, you get pre-money valuation. So here you can see the illustration. Basically, we have a terminal value that we've estimated that the company should exit at this value, divided by 1 plus hurdle rate, where hurdle rate is the required rate of return for the investor, to the power of the number of years or the period that it will take for the company to exit. Okay. So the terminal value is 10 million, hurdle rate is 50%, years until exit is 5. So this becomes 10 million divided by 1.5 to the power 5, and it gives a post-money valuation of 1316872. Okay. So what is the benefit of this method? The benefit is that it takes into account the growth potential of a startup, what would be the terminal value, and it also allows investor to actually set in his own hurdle rate in the valuation analysis, which was not being done earlier. The key disadvantages are that it is difficult to determine these underlying assumptions such as terminal value. Again, it is based on projections. So the inherent problem with projecting numbers remains, and it does not allow for follow-on issuances and resultant dilution. So we'll understand what dilution means, not just in this PPT, but also later when we look at the entire equity pie being cut off at every round of funding, and the promoter who initially started off with 100% of the pie, actually after subsequent rounds of funding actually may end up in single digit ownership. Okay. So dilution also has an impact on your resultant values. Okay, any doubts, any questions so far? Fine. Now we have the mid stage to pre-IPO startups, which are basically startups that have entered their rapid growth phase, are doing well, they are capturing markets, and they are soon reaching up to a stage where they can be counted as a seasoned company, and they can actually look at coming out with an IPO. So the two methods that are very popular at this time are called public comparables and transaction comparables. Let's see what these methods are. So a comparables based analysis or multiples based analysis expresses the value of an asset relative to some financial or operating metric. Example, sales, earnings, users of other similar assets. The idea here is that similar assets should be valued at similar prices. So this basically says that valuation is relative. If we have similar companies in a sector, then we can compare these companies and base valuation relative to each other, okay, depending on how they are doing, on different operating metrics like sales or earnings or number of users or subscribers and so on. Okay, so for example, companies like Amazon, Flipkart were initially valued at their GMV, that is their gross merchandise value. Okay. So how does it work? First step, determine a set of peer companies similar to the one you are analyzing. In our example to the left, we look at a fictional set of widget companies. Calculate an average multiple for the chosen peer group by taking the ratio of valuation to a relevant fundamental or operating metric. In startup land, we often use sales as the relevant operating metric. Looking at our example again, we calculate how each widget company's valuation compares to revenue, which is also called price to sales or PS. Multiply the revenue or other relevant metric for the company you are analyzing by the average sector multiple. The result is a justified valuation for your company. Okay, so let's see how this is done. Suppose we have four peer companies, 1, 2, 3, and 4. And the current valuation is 5,000 million, 10,000, 8,000, and 2,000. And their revenues currently is 200 million, 350 million, 300 million, and 80 million respectively. So we just calculate their PS score. Their PS ratio is nothing but valuation divided by revenue, okay, or price divided by sales. So in case of company 1, it's 25x, company 2, it's 28.6x, company 3 is 26.7x, and company 4 is again 25x. When we take an average out of this, it gives an average PS of 26.3, which is an average for the sector. So now we just look at our company and we look at the current revenue of our company. And when we multiply this current revenue with the average PS, we get the value for our company, which is 3946 million. Okay, very commonly used, this kind of a method becomes like a quick fix, a shortcut to valuation. Okay, and P multiples, PS multiples in case of startups are used very widely, very popular across valuation land. Okay, but everyone understands that this is just a shortcut to it. Of course, to get to the detailed valuation, you need to do more analysis. Okay. So the advantages are that it's very easy to implement and widely used, easily understood by market participants, very popular. Okay. The disadvantage is that average sector multiples can be impacted by temporary market conditions or other factors. How do you know that these companies' PS ratios are not affected by market conditions or something else? How do you know they are fundamental PS ratios? Then it doesn't always capture all of the factors that drive valuation differentials. For example, margins, growth rates, superior management teams, capital structure. For example, a company with stronger growth prospects might warrant a higher multiple than the sector average. So we don't look at the value creator differentials. Have you compared the margins that these companies have? Have you compared the growth rates? Have you seen what the management quality is like? Naturally, if a company is doing much better on these parameters, they should be valued higher. Okay, so this method does not include it in detail. Any doubts, any questions so far? Okay, I can see Monu Meena had joined and then he or she has left. I don't even know whether it's a he or she. Okay. Then we have transaction comparables analysis, which is also similar to public comparables. So similar to a company comparables analysis, transaction comparables express the value of an asset relative to some financial or operating metric. Again, similarly, sales, earnings, users of similar assets. The key difference is that transaction multiples are based on M&A evaluations rather than public trading valuations. So instead of just looking at the publicly traded companies or the companies existing in the markets, we look at only those companies that have actually entered into an M&A transaction, have been acquired in the past, and so on. As acquirers often pay premiums for M&A targets, transaction comparables are often higher than public company comparables. Okay, because acquirers will generally pay a premium naturally If someone has to buy you, they will pay you a value that is higher than your current value. And so the transaction comparables will generally generate a higher valuation. How do we implement this? Just as the public comparables, determine a set of peer companies similar to the one you are analyzing that were recently acquired. So naturally the subset here becomes much smaller. Calculate the average multiple for this group by taking the ratio of the transaction price to a relevant fundamental or operating metric. Again, in startup land, we often use sales as the relevant operating metric. Multiply the revenue or other relevant metric for the company you are analyzing by the average transaction multiple. The result is a justified valuation for your company. So the same thing is done over here, except that the companies that we are choosing are companies that have recently been acquired. Okay, so naturally their value would be definitely higher than the other companies available. So in this case, company 1 has a value of 6,000, company 2 11,000, company 3 9,200, and company 4 2,100. The revenue streams have been 200, 350, 380 respectively. So the PS or price to sales ratio is 30x in case of company 1, 31.4x in case of company 2, 30.7x in case of company 3, and 26.3x in case of company 4. So when we take an average, it becomes 29.6. Now we just multiply the revenues of our company with this average PS score to get our valuation of 4438 million. Okay. Again, the advantage is that it is very popular, very easy to implement, very easily understood by market players. The disadvantages again remain the same. The past transactions may not reflect current valuation conditions. Now, these companies could have been acquired a few years ago and they may not have any relationship to the current valuations that are floating around. Transaction prices and thus transaction multiples might be impacted by synergies, intangibles, and other factors that are particular to that transaction and are not applicable across the sector broadly. So mergers and acquisitions is a one-on-one negotiation, and it is based on joint synergies, joint considerations, which may not be generalized across the entire sector. Okay, so this is the disadvantage of this method. Any doubts, any questions so far? Okay, I hope everyone is understanding. Let me ask people. Aniket, any questions? Kamya, Shaurya, समझ में आ रहा है सबके?
Yes, ma'am.
ठीक है, कोई क्वेश्चन होगा, कुछ भी होगा तो फौरन वो करके अनम्यूट करके पूछ लेना, या यू कैन इवन टाइप इट इन द चैट बॉक्स और रेज योर हैंड, व्हाटएवर वर्क्स फॉर यू. ओके. If you're not asking me any questions, I'm assuming that आपको समझ में आ रहा है. Okay. Even otherwise, when you go through recordings, in case you feel कि कोई चीज समझ में नहीं आई है या इसको फिर से एक बार समझा दें, you can always reach out to Samriddhi ma'am, Harshita ma'am, or me. We are all here to help you. Okay. You can always reach out with your doubts or queries, whatever. Okay. Okay. Coming back. Now we come to the third stage, which is when the company is nearly ready for exit and is IPO ready or acquisition ready. And over here, the company already has operating histories, has enough revenues and assets so that we can apply the traditional valuation techniques to these companies. So we've already done the detailed discounted cash flow illustration in the beginning. We've also seen public comparables and transaction comparables examples. The only new method here is called the first Chicago method. Okay, very popular method again. Let us see how that is implemented. The first Chicago method is a combination of a DCF and relative valuation. The method requires three different sets of projections of company performance in a DCF and resultant valuations. So you have a best case scenario, that is financial performance exceeds expectations, you have a base case scenario where financial performance meets expectations, and you have a worst case scenario where financial performance is worse than expected performance. So from there, you decide on the probability of each scenario happening. The target's valuation is the probability weighted sum of each case. Okay. So basically, you just conduct a DCF analysis, but you assign 3 scenarios to it: the best case, the base case, and the worst case, which will yield 3 different valuations. Then you determine the probability of each of these scenarios occurring, and you multiply each of the 3 valuations by the probability of each scenario occurring, and add the probability weighted valuations together to arrive at a single valuation of a company. So what they do is, instead of looking at just one number, they assign economic scenarios to the future and also assign probabilities of that scenario happening. And based on each scenario, of course, you will have different valuations. You just multiply the probability with that valuation to get a weighted company valuation. In this case, it is 92.3 million. Okay, so what are the advantages? Advantages is that you're finally using discounted cash flows. So probability adjusted DCF valuation offers more flexibility than a general DCF by sensitizing for different revenue and cost drivers. Okay, but what are the disadvantages? The same associated with DCF. Suffer the same challenges inherent in a DCF, such as formulating reasonable financial projections and discount rates. Again, the same issue with projections. Okay. However, at this stage, I think you can safely project because the growth rate is known, the past cash flows are known, you pretty much know what is the capex required. So the strategy is also known, and you have operating history. So I don't think it is so difficult to project data accurately. Okay. Complicates a DCF further by adding another variable, probability of achieving the 3 different cases. So पहले आप कह रहे हो कि project करो basic DCF data, then you're saying project scenarios also on it, then you assign probabilities also. So again, it becomes more complicated, and that becomes a disadvantage. The valuation methods that I used at these 3 stages: first is at the seed development phase, second is at the mid or pre-IPO phase when you're in your rapid growth, and third is when you're actually ready to exit and you've reached a maturity phase or a seasoned company status. But there are other considerations also that you must consider when you are valuing any company. So the valuation methodologies covered above unsurprisingly focus on a company's financial metrics and assets. And that is why students, a course on financial management for startups or entrepreneurial finance is so important, because most of the valuations are built around the financial metrics. So you must understand all the financial terms associated with it. However, there are a number of valuation considerations that VCs factor into an investment decision that are not readily derived from company financial statements and projections or a thorough understanding of the business and market. These factors should theoretically be captured within a company's valuation as derived using the methodologies above, but they can be difficult to predict and quantify. We recommend that clients layer these considerations on top of any quantitative valuation analysis they perform. So what are these considerations? First, dilution. Earlier investors should expect that their ownership percentage will decrease over time as a company raises additional capital from new investors. So early investors like angels and all should know that with every subsequent round of financing, their ownership, their percentage will keep on getting diluted. Okay. Then you have preferred stock rights and onerous terms. Every series of preferred stock may have distinct terms and privileges compared to earlier series, making it potentially less advantageous to hold previously issued stock. So series of preferred stock may have, every time a new VC comes in or a new round comes in, they would put in their own preferred conditions, and that may make it less advantageous to the older investors who have been there from the beginning. Then failure rates. Every startup is unique, but the common rule of thumb is that 90% eventually fail. So you have to bear that in mind. The non-financial signals, the human capital factor is extremely important. So investors should pay attention to management, board, and existing investor composition. You must look at the human capital, the human factor, and that is so important. Okay, suppose you have a very high flying promoter or CEO, and suppose in the middle they decide to leave, then that can have a huge impact on the valuation of the business. So you must be able to include these qualitative factors as well. Okay. So let us look at each of these factors in slightly more detail. As you can see over here, in the beginning when the founder started off the company, he had 100% ownership. Then suppose you had a co-founder who decided to split the ownership into 50-50 and he brought in his own money. Now at the seed stage, you may get in an angel and you dilute, you give out 20% equity to him, and so both the founders are left with 40 each. Now in series A, that is your survival funding, suppose you get in a VC at 25% of equity, so he's left with 25% and both your equities go down to 30% and the angel's equity goes down to 15%. So this is called dilution or division of the equity valuation pie as with subsequent rounds of funding. Okay, so we'll look at this in greater detail through another case study where we'll see how the valuation starts changing with subsequent rounds. Okay, any doubts, any questions so far? Okay, so dilution can meaningfully impact startup returns. Dilution typically occurs when a startup raises a new round of financing. Existing investors will often see their percentage ownership reduced as new investors enter the cap table, even though the value of these ownership stakes in dollar terms may increase. So naturally, if you look at the Bansal duo of Flipkart, in the beginning, naturally, when they were co-founders, they had 50% ownership. And now their ownership, I believe, is in the single digits. But still, the entire valuation is their unicorns is in billions. So even that small percentage gives them much higher returns than what they would have gained even if they had 100% ownership. Okay. So we recommend that the investors adjust valuation for potential future dilution to better capture the percentage of total future value, company value that they will be entitled to receive upon IPO or acquisition or at the time of exit. So common sources of dilution come from, first, when you issue new preferred stock, typically occurs during new round of financing, or you issue new common stock, typically to co-founders, or you issue new stock options, typically to new employees, okay, employee stock options, or you give stock warrants, typically to lenders, banks, or you give convertible debt which will dilute ownership when it is converted into equity. So all of these aspects can lead to dilution in the future. Okay. A typical rule of thumb states that each valuation round will result in 20 to 30% dilution for existing investors. मतलब जो भी आपका ownership है उसमें कम से कम 1/3 dilution you can expect after every round. Most startups will raise at least 4 to 5 rounds before an exit. A formula for adjusting for dilution could look something like this. Adjusted valuation is equal to unadjusted valuation into 1 minus percentage dilution assumption per round, that is could be 0.2, 0.3 to the power of financing rounds remaining. So don't worry about this. It may look very complicated right now, but when we go through a numerical case study, then you will understand this better. But basically what they're saying is, on an average, with every round of financing, your existing ownership will get diluted by 30%. and most startups will at least have 4 to 5 rounds of financing before they exit or they have an IPO. Okay. Any doubts, any questions so far? Okay. Then of course we have the preferred stock rights and onerous terms. Preferred stock is nothing but preference shares. Not all stock is created equal, and different rights and privileges assigned to certain classes of shares can impact how we value them. We look at a few of the most common rights attached to VC-backed company shares and note how valuation should be adjusted to account for them. So first is the liquidation rank. This refers to the order in which investors or debt holders get paid in the event of company liquidation or bankruptcy. So what is a preference given for payment to each of your investors? This is a common preferred stock protection. All else equal, share classes with higher liquidation rank will have higher valuations. Common stock typically has the lowest liquidation rank. Naturally, because common stock or common shareholders will get paid absolutely at the end. Okay. Then you have another concept of accumulating dividends. While startups typically do not pay dividends on preferred stock, certain companies will declare dividends that accumulate over time and are payable at a later date. These dividends provide preferred shareholders additional return potential. Investors should adjust a startup valuation for any dividend liabilities owed to other share classes in the future. Okay. So for preference shareholders, you've done this as a question also. In cumulative preference shares, the dividends will keep getting accumulated. Okay. Naturally, if you have these kind of cumulative preference shares, and their valuation would be much higher. Then we have participating rights. Preferred shares are generally entitled to a minimum distribution amount, that is their liquidation preference from acquisition or bankruptcy proceeds. Participating rights will entitle these shareholders to additional distributions on top of their liquidation preference at the expense of common shareholders. So now, not just will they get their cumulative dividends, their preferred dividends, but they would also have a right to participate in the dividends that should be given to common shareholders. If you're investing in startup common stock, you may need to adjust your valuation lower to account for this additional payment to preferred. Okay, so please keep an eye out of the kind of stocks that are being issued, the rights that they carry, because your valuation may be completely dependent on the other stocks' rights. Then you have RASHE. Rashes are provisions that provide certain share classes with down round protection. Down round hota hai where the company raises a subsequent round of financing which can include an IPO at a lower price. Okay, so आप हायर प्राइस पे अभी तक फाइनेंसिंग ले रहे थे, लेकिन अब आपकी जो फ्रेश फाइनेंसिंग है दैट इज एट अ लोअर प्राइस देन द अर्लियर प्राइस दैट यू हैड. So this is called down round valuation. Matlab every subsequent round you're going down. With the RASHE, the company is required to issue additional shares to covered share classes in a subsequent down round. So just to make up for the loss in valuation, if you have a RASHE provision that the company will give extra shares to the covered share classes, okay, in case of a down round. Investors should always check if any share classes have RASHE provisions. All else equal, shares with RASHE provisions will have higher valuations than shares without this protection. So there are a whole lot of complicated kind of securities that are issued in startup world, and you have to be very careful as to the kind of security you are being issued and your rank, your participation, the dividends, the RASHE provisions, all of that you should look out for. Okay. Any doubts, any questions so far?
Ma'am, I have a question.
Hmm?
Ma'am, suppose initially I have 100% of the share, and we distributed like 10%. And for the next round, when we distribute furthermore, So that percent will be from the remaining one, or the remaining one will considered as the 100% or the left one only.
So typically in the first round of financing, when you only have the founder, then of course the founder's ownership will get diluted. ठीक है, because आप अपने ownership में से dilute करके आप दूसरे investor को ला रहे हैं. Okay, so suppose आपके पास 10% आप holding दे रहे हैं, so you are left with 90 and the new investor has 10. But with subsequent rounds, when you keep getting more and more investors on board, then naturally जो promoter है उसकी तो सबसे ज़्यादा ownership dilute होएगी, because उसका proportion सबसे ज़्यादा है in ownership, and you will also find the second or third round investors ownership also getting diluted when we have can you hear me?
Yes, ma'am.
Okay, because it's giving me a message bad network quality or something. Okay, तो थर्ड और फोर्थ राउंड में व्हेन यू गेट मोर इन्वेस्टर्स, देन नेचुरली जो फाउंडर है उसका तो ओनरशिप सबसे ज़्यादा डाइल्यूट होगी. बट सपोज आपके सेकंड राउंड वाले एंजल इन्वेस्टर्स हैं, उनकी भी ओनरशिप विल बी डाइल्यूटेड. ओके, बिकॉज आपका टोटल जो पाई है वो तो 100% ही है ना, उसी में से तो आप सबको बांट रहे हो. ओके काम्या?
यस मैम.
ओके, तो डोंट वरी. अभी जब हम लोग एक केस स्टडी करेंगे उसमें वी विल लुक एट ओनली दिस, that how with subsequent investment rounds the equity valuation pie keeps getting divided, कैसे आपका percentage ownership divide होता रहता है. Okay,
But ma'am, this will be little unfair on the part of जो starting से कंपनी में, because उन्होंने जब वो shares लिए थे तो the value of shares might not be that high. फिर जब
yeah,
कंपनीज ने थोड़ा ग्रो किया, फिर शेयर की वैल्यू हाई हो गई, और उसके बाद जब उनके शेयर्स में से और फर्दर डिडक्शन हुआ, तो won't this be a bit unfair?
yes, काम्या तुम सही कह रही हो, and this is what leads to what Harvard Business School calls a dilemma, which is the cash versus king dilemma. So आप जब अकेले अपनी कंपनी रन कर रहे हैं, then you're the king of your empire, right? I mean whatever you're making is 100% your own. या आप co-founder के संग कर रहे हैं तो everything is your own, and you can continue to start that way. आपको अपनी ownership को dilute करने की जरूरत ही नहीं है. But if you want to get rich and if you don't have the money to fuel your own growth, then investors like angels, VCs give you that ticket. And the kind of growth that they help you achieve through pumping in billions of dollars and mentoring you and everything, that would never have been possible if just the two of you had continued on your own. Okay, and that is why this is the dilemma. And naturally you don't remain king of your empire anymore. In fact, in a lot of unicorns you will find that जो founder थे उनको sideline कर देते हैं, उनको advisor बना देते हैं कि आप बोर्ड में बैठिए, और जो सीईओ है वो कोई और बन जाता है, एमडी कोई और बन जाता है. सो फाउंडर गेट्स रिड्यूस्ड टू अ स्मॉल शेयर होल्डर, but the founder is still happy even though he or she has lost their kingdom, but they have become rich beyond their wildest dreams. So this is the dilemma that every entrepreneur has to go through, whether you want to remain king or you want to get rich. Okay Kamya?
Yes, got it.
ठीक है, so there are a whole lot of papers and research on this, you can read through it also. And the other thing is that जब startup आपकी rapid growth phase में आती है, you need huge amounts of financing to actually scale up to that level, जो कि दो लोग जो founder group है उनके पास may be possible ना हो पाए. So how do you reach that kind of growth? You may not be able to reach it yourself. तो आपको कुछ तो compromise करना पड़ेगा ना, when you are getting someone else to give you that huge amount of funding plus mentorship plus models plus strategy. So you should be ready to sacrifice something in that regard as well. And for entrepreneurs who don't believe in this, who believe that sorry about that, who believe that no, we don't care, we don't want anyone else to have a share in our empire, हम लोग चाहे छोटे ही रहेंगे but we want to be complete owners of our kingdom, in that case you can choose to be a lifestyle entrepreneurial firm where you can be a small player and be your own boss. You can do that. Okay Kamya?
Yes, ma'am.
So I hope that answered your question. Anyone else who has a question or doubt? Okay, so let me go back to the material. The third issue that we were facing was startup failure rates. Now, startups naturally have higher failure rates than more mature, established companies. As we have discussed, valuation is a function of not just cash flows, but risk. We recommend investors should adjust startup cash flow estimates for probability of failure to take this risk into account. So the key considerations are, the statistic most commonly thrown around is that 9 out of 10 startups fail. However, there are many different ways that failure can be defined, such as bankruptcy or liquidation of all assets. That is one kind of failure. The second is inability to deliver projected return on investment. So according to research from Harvard Business School, if failure is defined as a former, then 30 to 40% of venture-backed startups fail. And if failure is defined as the latter, that is inability to deliver projected return on investment, then more than 95% of startups fail. Okay. So failure rates also vary depending on stage of investment, as is seen in the chart here. So typically at the seed stage, the failure to raise the next round is nearly 80%. Okay, and this keeps getting slightly reduced. Maybe in series A it becomes 50%, series B 55%, 62%, and so on. But the failure to exit is the highest when you are just developing your company or your product. And of course, as you move on through your life cycle, the failure to exit becomes lower and lower. But having said that, we still have nearly 40% of companies that go into liquidation, and we have nearly 95% of startups that fail to reach the promised ROR. Okay, and this we will also see when we look at professional VC, in case that is a part of your course, that how VCs design their own portfolio to take care of this large number of startups that would fail. Any doubts, any questions, please ask. Okay, then what are the non-financial signals that you have to look at? Key decision makers at a startup can have a meaningful impact on company value by providing effective strategic vision and leadership in execution. All else equal, startups with stronger management teams, board members, and partners are more likely to see favorable outcomes and may command premium valuations. By contrast, a startup with a weak management team or board should likely be assigned a discounted valuation. Okay. So management team may, below are several questions to consider when evaluating a startup's management team. First, does the founding team have a proven track record behind them? Does the team demonstrate expertise in their field? Do the skills of the founders complement each other? Okay. Then in terms of financial backers or board members, money in the world of VC often does not come unattached, as investors usually carry a board seat with the company. They want to sit on the board because it's their money. Each venture capital firm and partner can bring in unique insights and connections within the field that the startup operates in. Then you have strategic partners, where startups can also raise money from non-traditional VC firms to form strategic partnerships to leverage another company's resources. Similar to the connections that VC partners can bring a startup, it is important to understand the resources, technology, networks, etc. that a partnership can bring. Okay, so all of these have a very important aspect. So look at this Dilbert comic strip. VCs gave us $10 million, but I had to agree to put one of them on our board. So should I be worried that your other board members have a combined IQ of about 70? So they weren't dumb enough to give me $10 million. Okay, so basically the VC is saying, shouldn't I be worried that, your other board members have a combined IQ of just 70? So he's saying they weren't dumb enough to get me 10 million. So it's okay, you're on the board, fine. So these are the non-financial signals that you have to look out for. Finally, to conclude, there is no one size fits all approach to corporate valuation, and startup valuation is no exception. At this company, they triangulate the valuation using a mix of methodologies. So everyone does this, not just Equity Zen, but everyone does this, that they look at all of the methodologies and they try and pick up the best suited methodology for a particular startup's industry or sector, growth, disclosure, all of that. And then on top of that, they layer other considerations like dilution, management, and failure rates that may not fit neatly into any established valuation method. This approach may still yield a variety of conclusions and opinions, and that is part of the fun of investing and negotiations. Okay, so this is, I think, a good, anyway, you can read about Equity Zen. They have more than $1 trillion of market cap in terms of the investments that they handle. Okay, so this was the thing. Any doubts, any questions so far? Okay. Now what we will do is, since we have looked at all of these methods, you know, in brief through this PPT, we will now look at the detailed DCF techniques and all the quantitative tools that we use through numericals, through cases out of our material. Okay, so let me just share that my screen. If you have any doubts, any questions so far, you can please ask. Here, chapter 9. Okay. Is this visible, Samriddhi?
Yes, ma'am.
So let us just start with this small example. We begin with Jim, the owner-manager of the Frothy Slope microbrewery and restaurant in a small Colorado ski town, who has recently been the object of potential investor attention. The success of his first brew pub and the local popularity of his microbrews have resulted in a direct offer to invest $100,000 in ongoing operations and a desire to consider bottling and broader distribution. Although Jim has a business degree, complete with introductory exposures to accounting and finance, he is most comfortable overseeing the production of his handcrafted honey wheat ale. While he welcomes the eager investor, he also has no feeling for how much ownership he should be willing to sell in exchange for the $100,000 investment. So this is what happens with most sole proprietors or entrepreneurs, that someone has approached them, they're running a successful business, and they don't understand that how much of ownership should I dilute or how much of equity should I give for this amount of investment that someone is promising me. So how do we do that? Okay. Does the past matter? After some thought, जिम structures his approach as follows. तो अब जिम सोच रहा है कि हम कितना वैल्यू दें अपनी इक्विटी का for this $100,000 investment. I have $50,000 of my own cash in the brew pub and 1.5 years of 70-hour weeks that I have worked. I have only taken a small amount of cash out of the business for my living expenses, certainly not equal to a reasonable wage. In college, I worked at a brew pub for $10 an hour, but that college degree ought to be worth, just a second. Sorry, I had to have some water. But that college degree had to be worth at least $5 more per hour. So he's saying, when I was in college, I worked at a similar brew pub for $10 an hour, but now I'm a college graduate, so I should get at least $15 an hour. So it seems like I have about $131,900, that is 50,000 जो हमने cash लगाया था, plus 78 into 70 into 50. So that is 70 hour weeks into 1.5 years, that is around 78 weeks. Okay, into $15, which is the hourly rate. And so he has this much of cash and sweat in this brew pub. So according to him, 100,000 जो ये दे रहे हैं plus 131,900 gives a total of 231,900, and 100,000 by 231,900 is about 43%. So he feels कि okay, then I can take this money, give him 43% ownership, and still remain the majority owner. Okay, this is how he's thinking, and this is how most entrepreneurs would think. But no, before signing the deal, he decides to run his thinking by an acquaintance more closely connected with the financial aspects of business valuation and investment. That is you who's doing this course. Okay. Now here are the questions. What are the advantages and disadvantages of Jim's approach to determining the investor's percent ownership? What role, if any, do the $50,000 cash and the 81,900 sweat equity play in determining the post-financing ownership structure? Would the investor want less ownership if there had been 2 years of history rather than a year and a half? How will the investor make a return on the $100,000 investment? Does this relate to the existing investment? How would you structure an approach to answering Jim's question regarding how much the new investor should own in exchange for the $100,000 investment? Comment on the casual remark, investors pay for the future, entrepreneurs pay for the past. Okay, so suppose you are the consultant and you have to give advice to Jim, then what would your advice be? Can anyone tell me? Will you tell Jim to go as per his calculations and give 43% to this investor? Who all agree with Jim? Aniket? Or do you think नहीं मैम कुछ मिसिंग है इसमें? बताओ अनिकेत, काम्या, शौर्य बताओ. तीनों हो ही नहीं कि तीनों बता नहीं पा रहे हो?
बता नहीं पा रहा हूँ.
नहीं बता, मतलब यू थिंक जो इसने कैलकुलेशन किया है जिम ने वो ठीक है? अगर तुम होते तो तुम भी ऐसे ही कैलकुलेशन करते? हाँ काम्या, अनिकेत? Any observation, any comment? Okay, ठीक है, don't worry, don't take any risk. हम बताते हैं आप लोगों को क्या करना है. Okay. One difficulty in dealing with Jim's framing of the ownership structure, which is really a valuation question, is that he is intimately familiar with the struggle and the sacrifice of the past. Accordingly, he is not in the mood to be told that the value of his business is not directly related to the quantity of his past efforts in cash or sweat. हमेशा हर entrepreneur ये सोचता है कि मेरा इतना इसमें hard work गया है that it should be included in the valuation. Okay, but no. While accounting for the past is all well and good, an investor seeks to quantify and value the future. To the extent that the quantity and quality of Jim's historic efforts have laid the foundation for a lucrative future, new investors will compensate him. Ineffective or irrelevant past efforts are the entrepreneur's sunk cost. वो तो हो चुका है. They are not the basis of investor willingness to pay. Whenever someone is willing to pay you, वो past के लिए आपको पैसा नहीं दे रहे, वो तो future के लिए पैसा दे रहे, उनको तो returns future में मिलेंगे. Okay? What really matters in the valuation question is whether these past efforts resulted in a product or brand that can be the basis for future profits to repay the investor. Jim should be structuring his approach to address such issues as future customer base, consumption and sales behavior, distribution and quality issues in the growing outside the small Colorado town, the scope for the business, local, regional, national or international, the growth plan for any additional brew pubs, whether the presence of one of his brew pubs is integral to marketing his ales in other towns, and the margins on the various follow-on products sharing the same brand. With an eye to the future, 43% may vastly exceed the amount Jim needs to sell to justify the $100,000 investment. On the other hand, Jim's future might be so limited that the investor would be justified in demanding 75%. In either case, the future, not the past, is the basis of value. Different perceptions of the future will undoubtedly result in different valuations and ownership structures, even when launching from the same past. Okay? So कभी भी आप past expenses पे अपना valuation नहीं determine करेंगे, हमेशा future में ही determine करेंगे. So vested interests in value, investor versus entrepreneur. Once Jim understands that his past efforts contribute to value only indirectly, through their influence on the ability of the business to generate future profits and returns to investors, he sees the importance of business planning. The business plan जो हम लोग ने बनाया, that importance. To communicate effectively with potential investors, he will need to formalize and to the extent possible quantify his vision and objectives. If Jim had wished to remain local and sell only through the restaurant, a certain clientele of investors would have been willing to join him, vesting their hopes in the single brew pub. On the other hand, because his plan is to market his craft brewing nationally through normal retail stores and a chain of brew pubs, a different clientele of investors will consider partaking in the risk and return of the grander vision. Ascertaining the type of investor offering the $100,000 investment is critical. Communicating his vision effectively and attracting compatible investors who share the same vision or a highly correlated view of the future is one of the central purposes of a formal written business plan, which is what if you would have done 307, you would have learned how to make. Okay. It is clear that investors are not going to share all of Jim's personal objectives for owning and operating a chain of brew pubs. For instance, in addition to having a national consumer base, Jim may wish to locate pubs in towns he likes to visit or where his relatives reside. He may want to employ a relative as a chief financial officer. Similarly, Jim will not share all of his investors' objectives. It is common for upstream suppliers and downstream distributors to invest in order to solidify strategic relationships. Some of the objectives of strategic relationship investors may be at odds with Jim's objectives. So he could partner with anyone. He could put in his own family members at top management positions. All of this will have an impact on the future. In this and other investment contexts, however, there is a financial objective that, other things being equal, both Jim and his potential investor can support: increasing the value of the ownership of Jim's operations. Rarely do investors and founders agree on exactly how to increase value. Nevertheless, there is almost always an unwritten agreement that whatever the strategy, purchasing, operations, marketing, management, from the venture's viewpoint, the fundamental criteria for evaluation is the strategy's contribution, directly or indirectly, to the firm value. If Jim wants to appoint Dad as CFO, he'll be asked to explain to the other investors why this enhances value relative to other choices for CFO. If the venture's hops supplier has invested and wants the business to increase its hops inventory holdings, someone will have to explain why this is a net financial advantage. So every decision that he takes, he would need to justify that to the investors. Now, Jim and his potential investor have been debating two expansion strategies. Jim believes that to affiliate his crafted ales with the brew pub experience, early customers should continue to purchase his ales primarily at a company pub. Such belief dictates that pub operations be expanded relatively rapidly, or that licenses be granted to existing pubs with the proper atmosphere to sell his draft ale. Jim's potential investor thinks it is better to go with a few destination pubs, no licensed pubs, and extensive advertising to create a brew pub affiliation, as bottled versions of his crafted ales are distributed through normal distribution channels. While it is not clear how this debate will be resolved, It is obvious that one important criteria by which the strategies will be judged will be the bottom line impact on the value of Jim's venture. Valuation is how visions of the future are translated, quantified, interpreted, and made relevant to current investor negotiations. And that is why your business plan, which is basically the vision document and how you would try and achieve that, becomes the basis for valuation negotiations. For those who are interested in why economists, finance professionals, and academics focus on the present value of owners' wealth to choose a firm's strategic direction, a learning supplement, basically the time value of money, which we have already told you through the DCF technique, will give you the results. Okay. In such a context, it is easy to see how financial markets unify investor objectives for the firm without denying important differences in the way investors perceive a firm's investment and harvest opportunities. Recognizing the role of financial market signals and incorporating them into decision making can provide an important financial framework for investors and founders to use when evaluating the advantages and disadvantages of different expansion strategies. So agreement on an evaluation criteria is a first step towards agreement on the strategy itself. Okay, so here we come back to cash flows. Because investors look to the future for streams of cash they expect to receive, proper investment valuations begins with projected future performance. A venture's ability to pay investors future cash streams depends on its future performance in sales and expenses. So equity valuation cash flow is a cash flow used for valuing a venture's equity. Okay, so we'll look at the details later in this chapter. Equity valuation is a connection between a venture's ability to generate future cash and an investor's willingness to provide the funds necessary to achieve those future cash flows. In simplest form, the most basic valuation technique calibrates an asset's value by estimating future cash flows and discounting the cash flows for risk and delay. The total found when adding up all the discounted values is the venture's value. Valuations using this approach are referred to as DCF valuations, which we have already seen in the Equity Zen PPT. A venture's present value is the value today of all future cash flows discounted to the present at the rate of return required by investors. So beginning our discussion of valuation procedures with the DCF present value has the added advantage of providing a solid foundation for interpreting other more ad hoc methodologies to value securities. Okay, so this is similar to what we did in the DCF illustration in the Equity Zen slide. A DCF valuation should incorporate all of the cash that will flow to a given security. To provide tractability and expositional advantages, evaluators commonly partition the future into an explicit forecast period of 2 to 10 years, but these days 3 to 5 years is more than enough, and a terminal value. In our main approach to calculating the venture's terminal value at the end of the explicit period, the venture is modeled as growing smoothly at a reasonable long-term rate. A smooth venture is one that has matured to the point where its margin, profit, operating ratios, capital needs, and other business aspects grow in proportion to revenues. Such smoothness is certainly not the characteristic of a startup, but may be a reasonable approximation to the venture's character 5 to 10 years down the road. When the venture is no longer venturesome, there are some convenient mathematical simplifications for calibrating DCF values. Okay, so let us look at these valuations. Any doubts, any questions so far, please ask. Okay. Suppose a venture is growing smoothly, maintaining normal operating ratios and providing a growing at a rate G stream of payments to its investors. How would the investors assess the venture's DCF value at this mature stage in time? With the firm growing at a constant rate and maintaining its operating ratios, we can treat the cash flow in the terminal value period as a growing perpetuity. The current value of a growing perpetuity is the next period's cash flow that is VCFT, divided by the spread between the assumed constant discount, that is R infinity, and the growth rate. So we have already done this formula in equity Zen also. Terminal value is nothing but the perpetuity or the venture's cash flow at the terminal value divided by the required rate of return or the discount rate minus the growth rate that is expected in the cash flows. Okay. If you would have done a core course in finance, you would have realized that this is also equivalent to the dividend discount model that is used in valuation. The spread between the discount rate and the growth rate is referred to as the capitalization rate for the terminal flows. This is called the cap rate, R infinity minus G. When using this formula, the calibrated value is of time t minus 1. Okay. So don't worry about supplements. We will give you all the numericals on your teams only so that you can see. A few warnings are in order. The most common error in this approach to terminal value is an improper year T flow, that is VCFT. We sometimes refer to year T as a stepping stone year to remind everyone that it is the first step into the infinite future. The impact of an error in the stepping stone year affects all of eternity. So if the VCFT is incorrectly calculated, then the entire infinity terminal cash flows can be grossly inaccurate. Okay. It is important, therefore, to make sure that year T's flows are representative of the proper margins and ratios, and that the growth from year T minus 1 to T preserves those margins and ratios while accomplishing the intended smooth growth rate. Okay. So we now have the tools for the divide and conquer approach to DCF valuation. Because our terminal value is a time T minus 1 value, we can add it to the explicit flow for T minus 1 and have one spreadsheet with a finite number of columns. So we denote the discount rate over the explicitly projected years before the terminal years by RV to foreshadow the fact that the venture investor discount rate can be quite different from the mature firm discount rate. So naturally, the rate at which the venture is growing in the explicit forecast period can be vastly different from the actual terminal value growth rate. Okay. So this is how the formula is written, the DCF formula. Years are written from 0, 1, 2, 3, 4, where 0 indicates the current time, the present time. And then we have the venture cash flow 1 divided by 1 plus RV to the power 1. Then we have VCF2 divided by 1 plus RV to the power 2. And we continue like this. At the period T minus 1, we have VCFT minus 1 plus the terminal value divided by 1 plus RV to the power T minus 1. Now this terminal value we have already seen is nothing but VCFT upon R infinity minus G. So when we open this equation, then it becomes equal to VCF T minus 1 upon 1 plus RV to the power T minus 1 plus VCF T upon R infinity minus G into 1 plus RV to the power T minus 1. Okay. Don't worry if all of this looks complicated. When we solve the numericals, then it will become much easier to you. This last version separates the present value of the final explicit period flow, that is VCF T minus 1 divided by 1 plus RV to the power T minus 1, from the present value of the flows in the terminal value period, that is VCF T divided by R infinity minus G into 1 plus RV to the power T minus 1, which is also called the venture's reversion value. Okay. This reversion value, the time 0 present value of the terminal value, plays an important role in the pervasive venture capital methods of valuation. Okay. So this terminal value, which was used in the VCF, if you remember the venture capital method of valuation, plays a very, very important role. As we are showed that these symbols are a bit dense and their application somewhat distant, it is time to return to the valuation of Jim's brew pub. Okay, so let's look at this through an example. It will become clearer. To conquer his problem, we divide the future into 5 years of explicitly forecasted cash flows and a continuing terminal value period for year 6 and beyond. Jim provides us with his best guess for what his venture would have left over after all operating expenses and reinvestments in the first 5 years. That is 0 this year, 0 next year, 0 the third year, 200 or 2.5 million the fourth year, and 3 million the fifth year. That is year 5 is equal to t minus 1 in this example. In the sixth year, Jim believes that the mature venture would have a surplus after reinvestment of about 3.5 million, and this would be expected to grow at roughly 6% per year after year 6. He believes that his potential investor and he should expect to make about 40% on a 5-year investment. His investor has other equally risky investment alternatives that would provide a similar return if successful. Jim can't see investors, himself included, expecting to make more than about 20% a year for a mature brew pub and distribution operation. He backs this up with some data on a similar but older venture that is now publicly traded. Okay, so he's looked at his own strategy, he's looked at the discount rate which is most appropriate to him and his investor, plus he's also looked at another brew pub that went through the same cycle and then is now publicly traded. So based on this, we can now map Jim's best guesses for the symbols we've been using. T is equal to 6, RV is equal to 40% or 0.4, R infinity is 0.2 or 20%, growth is around 6% or 0.06, VCF1 is equal to VCF2 is equal to VCF3 is equal to 0, VCF4 is 2.5 million, VCF5 is 3 million, and VCFT is 3.5 million. So if we apply this to the formula, please remember students, it will all be plus over here. So we have 0 upon 1.4 plus 0 upon 1.4 square plus 0 upon 1.4 cube plus 2.5 million upon 1.4 to the power 4 plus 3 million plus 3.5 million divided by 0.2 minus 0.06 upon 1.4 to the power 5. Adding up all of the columns gives a current valuation of 5,856,935 for the frothy slope venture. So you can put this into a spreadsheet also, and you can just apply the Excel formula, which is NPV. Okay, and Excel will calculate this and give it to you directly also. It's very easy to do that. Most Excels have all these financial calculations. Yes?
Only 2 minutes are left.
Acha, okay. Thanks, Amriti. So over here, this value before including the money injected by the new investor is referred to as pre-money valuation. And while these calculations are relatively simple to do by hand, in practice, the actual calculations are frequently done using a spreadsheet function, which is Excel's NPV function, the net present value function. Okay, and this is how it looks in your spreadsheet as well. Okay. A post-money valuation is nothing but the pre-money valuation plus the new investment. So if we add the 100,000 new investment to the pre-money amount of 5.856935 million, we have frothy slopes post-money valuation of 5,956,935. So now we can say something about the amount of venture that Jim would be willing to sell for $100,000 financing. If we divide the new $100,000 investment by the post-money valuation of 5,956,935, we get 1.68%. That is approximately just 2%. Can you imagine? Just 2% from what 43% he was expecting to pay for his venture. Okay. So let me end over here. We will continue from this in the next class. Okay, and anyway, Fridays we have our presentation, so after that we will continue with this. Okay, Samriddhi, I hope the presentations are all set. I mean, the groups and everything.
Yes, ma'am.
Okay. Okay, so thank you everyone. I'll see you on Friday then. Thank you so much, Samriddhi, Kamya and Shaurya. Take care. Bye-bye.
Thank you.
Thank you, ma'am.